Hey friend, what's up? This is Jeremy. Welcome back to the channel. I'm a designer and I am the co-founder of Yieldr, which is a portfolio tracking app that helps you manage your dividends and watch your portfolio build wealth over time. Today I'm excited because we're going to jump into one of my favorite features, which is the Yieldr playlist. Now these are curated watch lists that are updated weekly from a universe of over 500 dividend stocks. And we've categorized them in different playlists for you. So you have high yielders that you can check out. You have dividend growers. You even have a list of dividend kings, which have raised their dividends for over 50 years, which is crazy to think about. But today we're going to zone in on one of my favorites, which is the Yieldr top score. And we're actually going to do something. I'm going to put some skin in the game. I'm going to use the Yieldr top score playlist to build out a dividend growth portfolio from scratch that we can monitor and follow right here on the channel. So you can see how this works in real time when you invest in high quality dividend stocks. Now, I do need to pause and say, hey, I'm just a dude on the internet sharing my journey. So even though this is a powerful tool, you have to do your own research. You have to have your own conviction. You can't just blindly follow me. So this is not investing advice. This is just educational and me sharing my journey of type of companies that I look for and I like to build a portfolio around. So let's look at this top Yieldr score playlist. So to remind you, we give quality scores for all stocks. You can look up any stock and find the quality score. And it ranges from 0, which would be not so great, to 100, which is nearly perfect. So we're going to jump in to show you, refresh you on what that score includes. So if we hop in the Allstate here, we can see the Yieldr quality score, and it is a 99, which is excellent. And this is going to include dividends, growth of the company, and financial stability. So it's got these three components that we are comparing. And if we jump in here and go a little deeper, we can see that dividend quality includes the dividend yield, the dividend growth, and the payout ratio. So how well can the company continue to cover that dividend in the future? And then we look at business growth. So this is how is the underlying business growing? This is where the money comes from to pay out the dividend. So this is revenue, free cash flow, return on investment. And then we get financial stability. So underneath it all, how financially secure is the company? What's their cash? And how does that relate to their debt level? So we're going to take all those in and give scores. And we can see here that a score of 85 or more is excellent. And the top Yieldr playlist that we're looking at right here, let's pop on back, is showing you from our investable universe with over 500 stocks, which companies are at 85 or greater. And you can see we have 137 companies currently on the list. And this updates in real time as these scores update. So it's always going to be up to date. You can jump in here and find great ideas for companies to invest in. Now, there's a few things you can look at with the playlist to help you start to find the companies that you want. So you can look at the day change. Maybe you can spot something that you can jump into, like right off the top here. I see Accenture lost 18% today. So this is something that we may want to jump in and look at. We can also filter by sector. So if you want to build out a diverse portfolio, you can make sure you're balancing that. And then we have dividend yield. So we can search from the highest yielder, which is VC Properties, down to the lowest, which is Vertiv, that's just 0.08%. But then we can look at dividend growth, and we can see that Vertiv has crazy dividend growth, a 5-year dividend growth of 77%. So we can kind of start to manage that over time from our dividend growers and our yield, and we can look at all that together. But it's not just about that, because again, this is about quality, and we know all these are quality companies. So now it's just about looking under the hood and seeing which ones we want to start to invest and build out this portfolio. So I'm going to start here at dividend yield, and I'm going to go down the list and start to just look at some companies so we can try to figure out what we want to invest in. So this is kind of my process on how I'm going to build out this portfolio. So right off, I want to check out VC Properties. So I can go in here and I can look. It has a great, excellent score, dividend 100. You can kind of look at the 5-year chart. And this one, I got to think about this a little bit, because I can see over 5 years, it hasn't really moved much. So there could be a reason for that. And we can look at some headlines. So the Caesars uncertainty created tremendous value proposition. Did more than the broader market. So here's a little context on the VC Properties that I know is that they own a lot of properties in Las Vegas, and Caesars was one of their biggest, and they are in the process or have sold it. And so that has really hurt the stock lately as people are kind of nervous about that. We can also see that while their dividend growth is strong, they have slowed down. And on September of last year, they only increased by 4% compared to, how they have been going. But that's okay because, we're looking at a high yielder. So actually a 6% yield, almost 7% yield with 4%, that's not bad. So we can look at some more details and check this out. Ultimate for me, when I come down here to the bottom and read about this, we can see that they own a collection of premier gaming, hospitality, entertainment venues. And I know that primarily they're centered in that Las Vegas strip right here and adjacent areas. For me, this is something that I don't like to invest in companies that are geographically concentrated, because if anything happens in that spot, then it's going to hurt the company. And that's a little bit of a risk for me that I don't necessarily want to take. So I'm going to move on from that one and let's see what else we have. One that sticks out to me is Main Street Capital. This is a company that I've always been interested in, but they've always kind of traded at a premium. So I've never really wanted to actually take that first step. But we can see from a dividend yield, 6.24% and a 4% growth rate. So similar to VC Properties. That's, pretty strong growth rate for a company that has over 6% yield. So if we jump into Main Street Capital, you can see 85, excellent, dividend strong, growth is the weak link, but still 71, and financial stability. Now they do pay monthly and have a 15-year growth streak. You can see the last increase though, it did go down. This is recent, May 3rd. So they just grew their dividend, but only 2%. So we do want to think about that. Now, one thing you'll notice here is they actually are commonly known to give out special dividends. That's the blue mark right here. So while that 6% is their current yield, that does not include the special dividends that they sometimes give out. So you're going to get a little boost there, which is nice to know. And you can see it's pretty consistent. In COVID, obviously, they did not give that out. I like this for a company like this because it gives them some leeway so they can continue to grow their dividend, but when it's good, they can share that money back with their shareholders. And when the economy or the business gets tough or slows down, they can take some of that money and reinvest it back in the business where they need to. I think this is a smart way to manage your dividends. The payout ratio is a little high, but that's because this is a business development company. So what that means is they provide loans to middle market companies. These are companies that kind of find themselves in a spot where they're not necessarily going to get a loan from a bank, but they still need to finance and grow their business. So they turn to these business development companies like Main Street to help fund them. Now, Main Street's interesting because not only do they provide loans, but they also, in some companies, become partners and own some of the equity. So they actually become part owners. A lot of their companies, one thing I like, are very focused in the industrial sector. So they're doing these things, helping companies grow. These are companies that you probably never knew existed unless they just happen to be in your hometown. Very solid companies that help grow the economy and keep the world moving. So that's something that I really like. I mean, to show you the diversity, we went from this industrial company to a pool builder. So you can see here that they have a lot of diversity in their companies. If we jump back to Yieldr, this is one that I would have on my list as one of those high yielding companies that I can, hold on to for a long time. Now, when you're ready to add it to a watch list, you can click this and you can add it. You can create a new watch list. You get unlimited watch lists inside of Yieldr. I've already added this to my list, which I will show you at the end here, which is going to reveal all 12 companies that we're going to base this portfolio on. But let's go back and let's keep researching. If we go on down, this one caught my eye earlier because it lost 18% in one day. And its dividend yield is 5%. It has 13% 5-year dividend growth and a 92 score. So there's a disconnect here between what the market is thinking and the market sentiment and the fundamentals and the dividend history. So when we jump in here, like most people, I'm curious how the stock has moved throughout the 5 years. So there is something happening here. It was at its peak, almost 400. And now we can see it's down 55% to 128. So what I know about this company right, is that it's a strong, high quality company. So you got the market sentiment over here, and you pair that with the quality score. Dividend 94, growth 85, financial stability 100. So again, there's a disconnect. And when you start reading through the headlines, the market is pricing in an existential crisis. The market is mistaking slow AI adoption for AI failure. So this is what has hurt Accenture recently. If you don't know what Accenture is, you can scroll down to the bottom. A global professional service firm that delivers a wide array of strategy, consulting, interactive technology, and operation services worldwide. So they are a company that is a consultant. They come into large companies, corporations, and they help them integrate new technologies, and AI is the big one. And this company all comes down to, if you think AI is going to help grow them, so it's going to be a tailwind, or if it's going to hurt them and be a headwind for them in the future. This is something we're going to look at. Before, let's just take a snapshot here of the company's dividend. So over 5%, 6-year growth. You can kind of see that growth stunted here a little bit, maybe around COVID is what I'm assuming. The last increase was September of last year, so they're about to roll out their next annual increase, but that was 10%, pretty consistent. Payout ratio has been creeping up a little bit, but 50% is still a solid margin of safety there. We like to see free cash flow growth. ROIC, this is the return on invested capital. And this is basically measuring, as you can see here, how efficient a company generates returns from the invested capital, so from the money that it invests. And an ROIC of 20 is excellent, and 15 to 20 is strong for most companies. So we can see they're below their average, but they're still in that strong range. So something you want to keep an eye on, not necessarily something that would deter me from, adding this company to the portfolio. Let's jump in here and actually look a little bit about Accenture. Just in case you're interested, you can learn more about what they do. So this is from their CEO, Julie Sweet. And this is interesting. I saw her interview yesterday on CNBC, and it kind of reflects this quote. Companies will have a greater technology landscape, but we need to completely change the narrative to inspire people to paint the future. It is human in the lead, not human in the loop. And this is exactly her trying to get ahead of the market sentiment, which is saying AI is going to hurt this company, versus the fundamentals, which so far is still saying that AI is actually going to help this company. And she's basically saying that we, the humans, we, the company, are going to come in and help you lead AI in your company, not just be in the loop. So they're trying to get in front of that narrative, and you can kind of see that on their website. So they're definitely trying to turn this here. We can look at the year to date and see it's down 50%, even the last week. So this is when they reported earnings, and you can see it drop. So this is that big drop. And that's because they actually had pretty strong earnings. It was pretty good, but they pulled back a little bit on their guidance. They are also buying some companies, some smaller technology companies in the cybersecurity space. And, some people look at that as a good thing. Some people think that's a red flag, that they're having trouble growing their revenue organically. So they need to go out and buy companies to try to grow that. So those are the type of things that you want to educate yourself on before you go and just, buy a company. Now, so that's kind of looking at how I would start kind of analyzing this. The next thing that I would probably do is actually switch over to dividend growth, because I want this portfolio to have a decent dividend yield, but also have continued dividend growth. So I know that I'm not just going to get that passive income, but it's going to be growing greater than inflation, and like a paycheck, like a salary, I'm going to get a bonus year after year. So as I filter this, I'm going to start to go down this list, and Vertiv is one that stands out to me. They're kind of tied into the data center world, but for me, 0.08% just isn't enough of a yield to add to this portfolio, since it's only 12 stocks. Now, one company that I've always wanted to own is TJX companies, or TJ Maxx. Now we can see it's a consumer cyclical, so it could have some ebbs and flow based on how the consumer's doing. But that's one reason why I like this company. This is a place where consumers go even when they're struggling financially. You can see they have a 1.17% dividend yield, so not super high there, but that could be a lower end stock for us to balance that high dividend yield. And their dividend growth rate is pretty extensive here at 48% in the 5 years and an 86 score. So they're right at the bottom of our score. Now, if we jump into TJX, we can see that they're currently trading a little bit of a premium, which they typically have. And if we look at their 5 year, you can see they have been on a trajectory straight up and to the right. So we just have to be comfortable knowing that, we're buying in a company that has seen a lot of growth over the last 5 years. And can they continue that growth? That's the question. Growth is sitting at 79. So that's something that we want to look at. Now, you can see some things here. Do you believe in the growth trajectory of TJX companies? This is exactly what I was saying. Can they continue to grow? The next news here, they were downgraded. These analysts, they upgrade and downgrade all the time. Jim Cramer says it's an ideal place to shop for value. Their last dividend increase was on March, so pretty recent, at almost 13%. So that tells me that they are so confident in their fundamentals, in their free cash flow growth, that they are continuing to raise. Now you can see they did not raise. They lowered their dividend in 2020 during the pandemic. That's understandable. I'm not going to really fault them for this because they jumped right back up to where they left off and kept the growth growing. Payout ratio got really high again based on probably the pandemic. Free cash flow is growing. ROIC is starting to tick back up back to their 10-year average at 22%. We know that anything over 20 is excellent. So that's really strong to see. The debt is, maybe their coverage isn't as strong, but it's still 0.39. And if we look at this, our benchmark is 0.3 or higher. So even though they're not as strong as they were in the past, they are, as you can see, slowly growing, and they're still within that strong range. And the interest coverage has actually been growing, so that's a strong metric to look at. Now, here's the question that you got to ask. Will TJ Maxx continue to grow? And you can see here all their different companies that you're probably aware. TJ Maxx, Marshalls, HomeGood, Sierra, HomeSense, which just opened up a HomeSense store in my town. First time I heard of that company. But the question is, will they be able to continue to grow over time? And this is where I want to show you this piece, because this is where I think the answer could lie. When I was looking in and researching the company, I could see that in the United States, they have TJ Maxx, Marshalls, HomeGood, Sierra, HomeSense, but they have international that, if you're just primarily living in the US, you may not be aware of this, but this is important to look at. So they're growing in Canada, Winners, HomeSense, Marshalls, in Europe, TK Maxx, HomeSense, and then in Australia, it's coming soon. So this is telling me that they are building out international presence. And I would want to dive into this and see what their strategy is, what their plan is for this. And these are some things that I have looked at in the past. And I know that this is something that they are actively trying to build out. So that is, a good sign for me to consider adding them to the list. Now, let's go ahead and actually jump in so I can show you all the stocks in this portfolio that we are going to start to build out. So again, I'm going to invest in this with my cold hard cash to show you that I do believe in our system, and I think it's a great way to find stocks and a great way to build a portfolio. So let's just go down the list. So this is all taken from that top Yieldr quality score, and you can see we made a pretty diverse list of sectors that we're covering. Main Street Capital, which we talked about, Torino Real Estate Corporation. Now, this one's interesting because, it's a real estate company, but it still has a 99 score, a 3.23 yield, and a 5-year 12% growth rate, which is really high for a real estate company with 3% yield. What I like about this company is it is industrial manufacturing blue chip company. It's been growing its dividend over time for 14 years. The payout ratio has been going down. That's, really great for a REIT. ROIC has shot up. There's a lot of things that you can like about it, but what I like is their strategy behind the company. So they acquire and own and operate industrial real estate in 6 major coastal markets. So when I look at this and I jump into the markets, you can see that they have these coastal areas where goods and supplies are coming and going from the US. And they are offering these industrial buildings where all this is getting stored and getting transported and moved, and they are like the home base for when these things come into the country and go out of the country. And I like that they are strategic and that they're not focused on just one area like we may see with VC properties that's really in that Las Vegas strip. They're spread out into 6 different areas. And I like that too because they're able to manage all their properties without it being spread out too much. So to me, it's a really nice balance. And you can jump in here and look, if we go into Washington, D.C., we can see they own 27 buildings, 98, almost 99% occupied. So that's great. And you can actually go in here and look at the buildings and, do a ton of research if you want at that level. What I think is cool is when you own a company like this, you are a real estate owner. You own now these properties. And that's one of my favorite things. Not only did I study design in college, but I also studied real estate. So I'm really attracted to this. I think this is a really strong company in an industry that I don't think is going anywhere. So this is one that I added to the list. I think it's a good balance. It helps give us some diversification with added real estate. And we can continue to see here that we just have a very nice mix. So we have industrials with ADP. ADP is a strong company. I love looking at their charts because it's usually just like this here, up and to the right, a consistent payout ratio. So they're able to manage their dividend, their free cash flow is growing. They've dipped a little bit in their ROIC, but it's still really strong at 25%. And they just have a great financial base to build off from. ADP, if you don't know, we can jump in to their website. They provide HR and payroll solutions to small business and large corporations. Now, while their stock has dropped, if we jump back and we look at this, you can clearly see that in the 1 year, they're down almost 30%. Now they were going up and up and up, just like their fundamentals were, and then they dropped. And that drop came from AI. And people are worried that AI is going to, take out their business, that people will no longer need their product because they can just build this in-house with AI. Now, I know working at a large company, you do not want to mess up HR. You do not want to mess up payroll at a big company. If you do that, you basically will lose your job and make a lot of people unhappy. So my thesis here is that strong fundamentals, a 91 excellent score, that this company isn't going anywhere. And AI is not going to, drastically affect this company. That's just my personal opinion. Again, you have to do your own research. But if you look at the average fair price, this kind of shows us that right now is also probably a good time to buy. The PE ratio is at 20 and the 5 years 28. Free cash flow shows a 39% discount. Dividend yield theory. So the 5-year dividend yield is 2% and we're a little over 3%. So that's also, all 3 metrics are pointing to a discounted value here with ADP. So let's go back to our list. We have Zoetis. This is an animal healthcare company. So they're pharmaceutical for both companion, these are your pets, and also livestock. So they are the leader in that market. They have, had some misfires with some drugs recently, some of their pharmaceuticals, and their stock has been hurting because of that. If we zoom out here to the 1 year, you can see they're down almost 50%. And I think it's important when you're building a portfolio like this that to balance those value companies, turnaround stories, with the companies that have strong fundamentals like we saw with Torino Realty, TJ Maxx. So you're kind of balancing that to kind of keep your portfolio stable. Now, Microsoft, you probably don't need a big introduction to them. They have also been struggling some lately. They're one of the Mag 7s. But lately, their 5 years up 44%, but their 1 year is down 20%. And people are thinking, the thesis here, the market sentiment, is that Microsoft is spending a lot of money on free cash flow. You can see their payout ratio has dropped a lot. I mean, it's still very good for a company at 20%, but it's dropped because they're spending more of their free cash flow that they're bringing in, not just on the dividend, but back in the capex to try to get ahead and invest in AI. And some people are nervous that there's going to be an AI bubble. Some people are also nervous that Microsoft isn't in the lead and won't be able to get in the lead. Now, I have some, personal experience with this coming from a large company that is built around Microsoft products, and I can tell you that we use Microsoft only. So we can't even use AI outside of our ecosystem, which is Copilot and Microsoft. I think there's a lot of companies like that are gonna continue to use Microsoft because it's so ingrained in a corporation with thousands of people using it. It's just a difficult ship to turn when you try to change that. You have Accenture, you have, which we've talked about, but you have Rollins. Now, this is a company that is a consumer cyclical as well. It's also, for me, I would say a little industrial. And you may know this as a local brand to you, but it is pest control. And local here, I think the Rollins, they own Orkin. And that is the brand that is here in the area that I live. But you can see, they typically trade at a premium. So there is a little bit of a discount according to our valuation. If we look at the 5-year, we can see they've had strong growth and now they have fallen. And you have to kind of, again, this is a signal to look into that. Why have they fallen? When I look at their metrics, they have a 1.6% dividend yield, 10% growth. Averaged over the last 10 years is 13% growth. You can see this dividend growth over time. You can see a steady payout ratio. I love when I see free cash flow growing like this. ROIC has been pretty consistent, again, over that 20% mark. Coverage is good. It's just a solid company. And one of their strategies is, they buy out different companies. So they buy out pest control companies in certain areas. And, you can look at their brands here and see where they've done that. If we look here, yeah, these are all the different companies that they have brought out and rolled under their corporate Rollins brand. And you can see Orchid here is the one that's in the area where I live. They do residential, they do commercial. If you own a home and you have termites or you own a business, you have to address that. And most likely you're going to call someone, and who's going to appear at the top of your Google search is going to be one of these rolling companies. So I think it's a strong company to hold long term. Another company we're going to add is Snap-on, and a 2.5% yield, almost a 15% dividend growth rate. And we're going to diversify here into industrials. And we can look at their trajectory here, growing up and to the right. Now they are trading a little bit at a premium. And again, while I love to buy at a discount, I'm okay to have some stocks that are trending up. They have that momentum, and sometimes the market rewards that momentum. So I'm okay of mixing that in. It's more about owning great companies and finding solid companies that you can own for the long run. Now, if you're not sure what Snap-on is, they are an industrial company here that owns tools. Just like Rollins, they have a bunch of different tool brands that they own, and they operate in different segments. So you can see automobile, aerospace, collision, construction. So, these are people that use these tools, and they need specific high quality tools. You're not, as a consumer, we're not usually thinking about the tools that are needed in these types of businesses. Now, one thing in my research on the company that I want to share is they have this, I forget what they call it, but it's something to do with their Snap-on standard. And that's where you've probably seen the Snap-on vans out there driving around. This is where they go to the warehouses, to the shops that are using these tools, and they meet one-on-one, build a relationship with customers. When a tool is damaged, they'll replace it. And this is the kind of stuff that, when you have a car company and then you're fixing cars, you're fixing construction equipment, you don't have time to go hunt for tools or a tool break. You need a tool that you can rely on, a company, and that's where Snap-on comes into account here. So let's keep on looking. So we have Allstate. You know them from the commercial, property and casualty insurance. So they take on a little bit of risk, but they have money there always coming in. You can see their dividend growth over time. You can see their free cash flow growth the last few years has skyrocketed. And also I'll point out, when we have different industries that have different metrics. We change the chart. So this was, return on invested capital for most companies. Here we're measuring return on equity, and you can get a little bit more info here, and we can see that above 15 is generally considered strong and above 20 is excellent. They've averaged about 12. They're currently the trailing 12 months at 47. 2025 was 33. So really strong fundamentals underneath this company that we all know and love, but you probably might not have thought about investing in them. Go down, TJ Maxx, we already covered. EOG, this is a gas company. They are similar to what you would think of a Chevron or an Exxon Mobil, but they are on a different side of that. So they are involved in exploration, development, and production of oil. So they don't necessarily take it to the pumps like a Chevron, but they are out there discovering and actually getting the oil. And one reason we want to add this, one, it brings in that diversity of an energy stock, but we're also going to see that it's going to boost our yield a little bit, over 3% yield, and still, strong growth over time. And if I'm not mistaken, it looks like they pay out a special dividend or have in the past. And then lastly, we're going to have the financial toll booth in probably everyone's wallet, and that's Visa. This is actually a company that I own in my 12 stock portfolio, which is all the companies that I currently own. So I'm almost doubling my portfolio holdings by starting this portfolio here based on these Yieldr quality scores. But Visa is a company that is in everyone's wallet. When you need to make a transaction, they're always getting a piece of that cut. So it's pretty cool to think that you are buying something, Visa's getting a cut of that, but then you're also getting a cut back because you now are part owners of Visa. You can see great dividend history, solid, consistent payout ratio, free cash flow is growing, ROIC is growing, debt, interest coverage is all super great. This is just a solid company. It's like ADP. It has the best left and to the right types of charts. So that brings us to the end. You've seen all 12 stocks in the portfolio. I've kind of showed you my process on how I go and find these stocks, how I use the playlist to help find the high quality stocks that I can rely on for that dividend income steady, consistently, and where I am going to be investing my money. Now, in the next video, we are actually going to jump over to public. I have them sitting here ready to go. It's June 19th today, so the market's not open, but here's the list in my watch list. I am ready to actually buy these in my public brokerage account, which I just opened just for this portfolio. So I'm actually going to show you how you can connect your brokerage. So once we make those investments, I'm going to show you how you can come in here, create a new portfolio, and link your brokerage. So we're going to use this tool to find public and then actually connect it. And then we're going to look at the dashboard, and you can see how all that works and what you can expect once you actually create your first portfolio. So until next time, happy investing.